This is my first one of the IFRS discussions or conferences here. Like Pete, I'm also wearing a dark suit. So, like Erez said, there's not a whole lot happening in IFRS. Most things have kind of settled down in the last year. So much of what I'm going to talk to you about is either interpretations or just kind of a reminder as we head into the December busy season and how to kind of little tips for your financial statements. So we're going to start off with IFRS 21, which is levies. This was a new interpretation issued in May 2013 that is applicable for year ends beginning January 1st, 2014. So starting off, what is a levy? So the definition is an outflow of resources imposed on entities by governments or similar bodies in accordance with legislation. There would be really three types of levies, and you have to ask yourself three questions when defining a levy, which would be, is the payment imposed by a government or a regulatory body? If yes, then you're potentially in the realm of a levy. Number two, is it non-reciprocal? What does that mean? Am I paying a government and am I buying property from them? So in that case, there would be a reciprocal asset required. A non-reciprocal payment would be, I'm giving them money to carry on business, but I'm not getting anything back. So there's no contractual services that are being exchanged. So if it is a non-reciprocal payment, you're again in the realm of a levy. And three, is the payment covered by another standard? If it's covered by another standard, you're scoped out. So an example of that would be income taxes. That is something that you're not getting anything back for, anyways, we don't believe we are. And so that would not fall under IFRS 21. Some examples of levies would be royalty payments, lease payments, license fees, taxes such as property taxes, payments to organizations, administration fees, and use fees. Exclusions, as I spoke about, are income taxes, payments for acquisition of assets from the government, payments for services rendered, fines or penalties. Again, they don't fall into this scope, and arising from emission trading schemes. So how do you recognize a levy and when do you recognize it? The time when the liability needs to be first recognized is when the triggering event for that levy has occurred. So what's the triggering point? It could be a variety of things. Revenue recognition. Some levies would be, for instance, the moment you start earning revenues, you must pay the government $100,000. The earning of the revenues would be the triggering event. Another one, once you become a banking organization, you owe a certain fee. That becoming the banking organization would be a triggering event. So you must determine the triggering event before you decide on how you're going to record it. So to determine the event, once you determine the event that gives rise to the levy, it could be recorded three ways: at a point in time, progressively, or after a minimum threshold has been reached. So if you were to record it progressively, the entity would be obligated under legislation to pay a levy calculated, for instance, as a percentage of revenues over the course of your year. So that means, let's say that would be similar to a royalty. So let's say you had to pay 2% of your revenue. You'd be recording that progressively. There would be no accrual. There'd be no one point in time where that's recorded. Every dollar that you earn, you have to record a 2% levy on that. So that would be recognized as the revenues are earned on a progressive basis. If it was a point in time, an entity would be obligated to pay the levy in full at a particular date after a particular event had occurred. So, for instance, as soon as the entity generates revenue, as soon as, like I mentioned, changes their operations to a different industry, and then finally, if after a minimum threshold has been reached, and that would be similar to revenues and the fact that you don't owe there's no levies until such a time you make $1 million in revenue. At what point? Then it would either be at a point in time or progressively, depending on the agreement. So IFRS 21 is silent on whether we recognize the asset or expense. They do talk about how to record the liability, but what's the debit side of this transaction? So there's no certain. It's not clear, except for there has been discussions on it, and basically, what we would I would recommend, not Davidson Company, not the opinions as Pete said, but it would be to follow your accounting policies. So for instance, if you were paying certain costs that continue to they meet the characteristics of an acquisition cost, for instance, then you could capitalize them as an asset. But if you were paying penalties or fines, sorry, not penalties or fines, but lease payments that were allowing you to continue earning revenue, that might be something that you would expense. An import duty on equipment, that would be form potentially part of the acquisition cost of a piece of equipment, so that could be capitalized. One of the final items is the triggering event is the only factor that should form the decision on when to record your levy. Even if you see the future happening and we're going to earn revenues in 6 months, we know it's going to happen, this is going to happen, and we're going to have to pay the levy, you don't record it until such time as that event occurs. Other considerations for Canadian companies, property taxes, that is considered a levy. How do you account for that? We're assessed annually or semi-annually. Again, there was discussion on this topic. They basically have come to the conclusion that would be recorded ratably over the year. The triggering event is the ownership of property, even though you're being assessed on an annual or semi-annual basis. The fact that you own property, the assessment's just purely administrative. So, moving on. So use of estimates and judgments, this is nothing new. This is just more of a reminder as we come into preparation of the financial statements. We have had discussions and comments from Canadian Securities Commissions in the past about the disclosure or the lack thereof surrounding significant estimates and judgments in the financial statements. So entity must disclose during the preparation of the financial statements your significant estimates and judgments that you use in preparing them for the period end. However, you only need to disclose the estimates and judgments that have the most significant impact on the statements. So that's a reminder that not every single estimate, not every single judgment needs to be included unless it is significant. So for instance, if you have a $10 million balance sheet and you have $20,000 in equipment, the life of your equipment and the depreciation methods would not be considered a significant estimate. Examples of areas using significant estimates. For a typical exploration company, I would say stock-based compensation. You've got volatility, expected life, interest rate, and forfeitures. Life of equipment, like I talked about, if it is significant. Decommissioning liabilities, you have significant estimates as it relates to the life of the mine, the interest rate, the inflation rate, estimated cash flows. And then there's judgments surrounding going concern. What is a cash-generating unit as applies to the company? Impairment testing, and whether or not there is even a decommissioning liability that exists. These are all could be significant judgments. So how do you disclose it properly? Avoid boilerplate. Often we find one note from a strong set of statements and that carries through the whole industry and then doesn't apply to it carries over for a long period of time and a lot of it ends up not applying to the company. Separate your discussions from your estimates and your judgments. Make clear which items are estimates, which ones are judgments. And describe the issue and tell the story. So why is it an estimate or a judgment? How do you determine it? What financial statements accounts could be affected, and why is this relevant to your company? And as mentioned, we can always help with additional examples on that. And finally, from me, decommissioning liabilities. This is, again, nothing new. But in 2014, there was more discussion. There was a viewpoint issued specifically as it relates to oil and gas and revising your decommissioning liability. So I thought it'd be a good opportunity to kind of just revisit it because it's becoming a bit of a hot topic as time goes on and how it's being assessed, how it's being estimated, and also revisiting on a period-by-period basis. So generally, as we probably know, but I'll just revisit it for the sake of fun, I suppose. Decommissioning liabilities is a legal or constructive obligation associated with the retirement of a long-lived asset that results from acquisition, construction, development, and normal operation of long-lived assets. So in most of our cases, that's going to either be your mine, your exploration and evaluation assets, or oil and gas properties. Some examples of a decommissioning liability would be dismantling the cost of dismantling a piece of machinery, the cost of removing and transporting that machinery, environmental costs and restoration of the site, and constructive obligations, as Pete mentioned. This is another one. So what is a constructive obligation? Pete defined it. It's an established pattern of practice, published policy, a sufficiently specific statement, so something that you've outwardly said that's very specific that you're going to do, or the entity has indicated to other parties that it will accept certain responsibilities. So in the case of decommissioning liabilities, what does this mean? Often it means, okay, after we leave our site, we're going to clean up our area, but we'll also clean up and restore the land that's adjacent to us. Something like that they've put out to the public. While it's not legally binding, it's something that they've put out there that they're going to do and that they have often past practice of doing. So that needs to be included. Quickly, how do we record a ARO? When you record your present obligation discounted at the pre-tax discount rate, the discount amount over the expected life of the mine, and that discounted balance, it becomes your asset and your liability. So you increase your asset by the amount of the discounted cash flows, and you increase your liability by the same amount. The asset portion of the decommissioning liability does form part of your CGU, or your exploration evaluation property. Often I see a lot of times those have been separated out not on balance sheets, but in the trial balance, and are accounted for separately. So that does form part of your impairment testing. Any depletion calculations, that forms part of, any depreciation, that forms part of that calculation as well. So don't forget about that number when you're doing any of your assessments. So just imagine it as part of the cost of acquiring your asset in the first place and treat it as such. And the liability obviously is accreted back up to its original undiscounted value over time. So that's the initial recognition, and we've probably all dealt with that in some form or the other. But what happens when we need to revise it? So IFRS requires that we review our decommissioning liabilities on a period-by-period basis to ensure that there's no changes in the estimates and underlying assumptions. If there is, and it's significant, often they won't be significant from a period-to-period basis. Discount rates don't change every quarter. Inflation doesn't change every quarter. Cash outflows wouldn't either. But if there is, then we need to revisit that calculation and amend it. What are the results? Why would it change? Changes market conditions. So a jump or decline in the risk-free rate or in the inflation rate where the property is located could result in a significant change to the decommissioning liability. Changes in technology. So new processes used to remediate the property may come into play, and as a result, cash outflows might change. Changes in legal requirements, new requirements of the jurisdiction. So changes in the term of agreement, pay attention to your agreements. Maybe at the initial outlay of your agreement, you're alleviated of any responsibility for potential reclamation costs. When you amend that agreement, that could change. All of a sudden, you might be responsible for a portion of it or all of it, and that could easily get missed in decommissioning liabilities. Changes in social and political environment. That could often relate to constructive obligations as well, and what you've promised a community or the social society where you're around. So how do you account for the change in the decommissioning liability? If the decommissioning liability increases or decreases, the accounting for it's the same as the initial recognition. However, when you increase your liability, your asset's going to increase. Now you have to look at, is my asset impaired? Is there any indications of it impaired? Do I need to do an impairment calculation? That being said, for E&E assets, generally speaking, I wouldn't expect an increase in your asset retirement obligation to affect impairment all that much. There's no cash flows and there's no net present value, so it would typically, unless there was other indicators, I don't believe that a change in your decommissioning liability would overly affect that. But if you're decreasing your decommissioning liability and your decrease in your decommissioning liability exceeds the value of the asset that it relates to on the balance sheet, on the statement of financial position, you can only reduce your decommission or your asset balance to zero. Any excess is recorded in profit or loss. So if I had $1 million change to my decommissioning liability and I'm decreasing it by $1 million, and I only had $750,000 on my balance sheet, you'd have a recovery of $250,000 on your income statement. Other considerations, oil and gas companies versus mining companies. So oil and gas companies, you're going to see an asset or decommissioning liability recognized much sooner than in a mining company. As soon as the drill hits the ground, pretty much there is some form of ARO to be recorded. This is often supported by rate prescribed by the provincial jurisdiction. So I know Alberta and Saskatchewan, they have rate sheets, and that relates to the location of the well, the depth of the well, and you can easily find the estimate for the decommissioning liability based on each well. So there's a little bit less estimates involved, especially in those jurisdictions where there's a rate sheet. So pay attention to that. Oops. Yeah, exactly. We'll follow them after. And it will often be a smaller ARO than you would see in a mining company. As it relates to exploration companies, you're going to recognize it much later on. It's not going to be as applicable to grassroots companies, but it'll be nearer the development stage, but certainly before the commercial production stage. It'll often be a significant number, and there's more uncertainty about the timing. There's a longer time between initial recognition and your life of your mine. The cash flows are often going to be a bit more uncertain, and it'll often require a specialist to estimate it. On another note, many governments, a lot of them are starting to introduce the financial provision arrangements, so bonds, which guarantee the availability of funds for decommissioning and rehabilitation of mine sites if the operator were to take off or default on its obligations. This can be an indication of asset or decommissioning liabilities, but it isn't always. So if that is something that you have, it might just have a look at it, see if there's anything underlying there that you have done damage to the property and there's a cost involved. That being said, decommissioning liability should only represent the current damage that you've done, and not, if you have a closure plan, the future costs that might be involved. It should only be what have you done today? What do I need to record today? And that's it for me. I'm going to pass it off to Erez, and he's going to give us hope for the world.